New Zealand's inflation falls more than expected, with markets now wondering if a 75 basis point cut in November will be on the cards. UK inflation was also weaker overnight. Australian jobs growth is expected to slow today, and the Philippines and Thailand cut rates. That's coming up in our 5 Things in 5 Minutes. And then in our bonus deep dive interview, we'll have the second part of our piece on Australia's housing market tomorrow. But today, ANZ senior economist Miles Workman explains what New Zealand's weaker inflation could mean for the Reserve Bank in November.
That's where the conversation is going to be over coming weeks. It's that sort of tossing up between a 50 and a 75 basis point cut, but for our part, we're still in the 50 camp.
But first, in 5 and 5 with ANZ. UK inflation was weaker than expected overnight at 1.7% annually, sending the pound down 0.5% against the US dollar as traders started to expect 25 basis point rate cuts in both November and December. Meanwhile, the S&P 500 was up 0.3% at 4 a.m. Sydney-Melbourne time as investors digested earnings reports. Tonight, attention turns to the European Central Bank's decision on whether to lower its 3.5% policy rate for the third time this year. ANZ Chief Economist Richard Yetzinger says it will.
Both the inflation and activity indicators are consistent with lower interest rates required. Somewhat perversely, the ECB seems less likely to deliver a 50 basis point surprise than obviously the RBNZ has been and the Fed has been, when the case in both those economies for 50 points was really on a forward-looking basis, whereas there's enough evidence in Europe, I think, that the ECB needs to try and get ahead of this disinflation and slowing activity. But the ECB is a collection of central banks and so will likely be conservative and deliver 25 basis points.
And the Aussie dollar was trading down 0.5% at 66.67 US cents at 4 a.m. Sydney-Melbourne time. The Kiwi was down 0.4% at 60.59 US cents. Number 2. New Zealand's inflation rate fell more than expected to 2.2% in Q3 from 3.3%. Tradable prices fell 1.6% from a year ago, and non-tradable inflation was below expectations at 4.9%. ANZ senior economist Miles Workman says while that's still too high, underlying economic weakness means it won't stop further cuts.
The Reserve Bank is certainly benefiting a lot from the global disinflation underway currently, but the domestic side of the basket is still a little bit sticky. However, if the Reserve Bank do wait for non-tradables inflation to get down to where it kind of needs to be, which is about 3% year on year to be consistent with stable headline inflation at 2% over the medium term. If they wait for that to happen, they would have guaranteed to held interest rates too high for too long.
Number 3. Market pricing immediately shifted to slightly more than 50 basis points worth of cuts at the RBNZ's next meeting in November. That indicates the discussion will now turn to whether it will be a 50 or 75 basis point cut. Miles says ANZ research is sticking with 50 for now.
They do need to be forward-looking here, and the trajectory is certainly showing that there's further disinflation to come on the domestic front. So entirely appropriate for the RBNZ to look at this data and conclude that perhaps another 50 basis point cut in November would be a good strategy, given that it looks like it would be a good time to get the OCR back to a more neutral setting.
Number 4. In Australia today, the RBA will be keeping a close watch on September jobs data after admitting last month that it had been surprised by ongoing strength. ANZ Head of Australian Economics Adam Boyton expects unemployment to hold at 4.2% and employment growth to slow slightly to 25,000.
My expectation based on leading indicators of employment, so things like the ANZ Indeed job ad series, is that employment growth should slow as we get toward the end of this year and into next, but we're not expecting outright falls in employment. It's more that over time, I think the pace of employment growth, which has been really quite strong recently, will come down a bit.
Number 5. The Philippines Central Bank cut rates as expected by 25 basis points to 6% yesterday. Also, Bank of Indonesia paused, holding at 6%. ANZ research forecasts both will cut again in December. The Bank of Thailand, though, delivered a surprise 25 basis point cut earlier than expected. ANZ economist Crystal Tan says the decision there was not unanimous. 5 decision makers voted for a cut and 2 for a hold.
Now that the cut has materialized earlier than anticipated, we don't think a back-to-back reduction is on the cards. The cut should be seen as a recalibration in line with the economy's potential growth and not the start of a deep easing cycle. It is notable that the Bank of Thailand characterized the revised policy rate as neutral. So overall, we are sticking to our forecast for the policy rate to end 2024 at 2.25%. However, we do think that the risks to the Bank of Thailand's growth forecast are to the downside, and we continue to anticipate a further 25 basis point cut to 2.0% in Q1.
Crystal tan there. Now, in our bonus deep dive interview, we did say yesterday that Maddie Dunk would discuss Australian household sizes, and we'll have that tomorrow. Today, though, after that drop in Kiwi inflation, ANZ New Zealand senior economist Miles Workman takes us through the intricacies in the data.
The non-tradables side of the basket, look, that's the side of the basket that policymakers should be most concerned about, because that's the side of the CPI basket that does tend to be quite sticky. Now, on that front, we did get a negative surprise. Inflation was a bit weaker than expected. 1.3% quarter on quarter versus our expectation of 1.5%. However, the big miss versus our forecast actually came from the family boost package, which is a rebate to households. So our understanding going into this data is that this wasn't going to affect the measured price of early childhood education, but in actual fact, that's not how Stats New Zealand ended up treating the policy change, which basically meant the early childhood education class within the CPI fell 22.8% quarter on quarter. Excluding that rebate, early childhood education would have actually lifted 6.9% quarter on quarter. The tradables side of the basket, this is the imported goods and import competing side of the economy, that's well in disinflationary territory. In fact, it's in deflationary territory. Those prices contracted 0.2% quarter on quarter.
Potentially talk of a 75% basis point cut to end the year with. What do you think about that?
Yeah, look, I really wouldn't be surprised if today's data didn't see that conversation sort of skew more towards 75 basis points in November than it has recently been. Look, for our part, we're still penciling in a 50 basis point cut, but you have to remember we've got the Q3 labour market data out on the 6th of November, and if that one's weaker than expected, well, combined with the confirmation that we got in the Q3 CPI that things are going the right way, then you certainly couldn't rule out a 75 basis point cut in November. So I think that's where the conversation is going to be over coming weeks. It's that sort of tossing up between a 50 and a 75 basis point cut. But as I mentioned, for our part, we're still in the 50 camp.
In terms of that tradables, non-tradables mix, I guess looking at the tradables side, there is a risk that global disinflation stops or slows. And is that a risk in terms of meeting the 2% sustainable inflation target?
Yes, it's definitely a risk over the forecast horizon. So tradables inflation, when it moves, it tends to be quite volatile, but you cannot rely on tradables inflation to remain deflationary or disinflationary on a persistent basis. We're in a period right now where annual tradables inflation is running at negative 1.6%. Chances are it will be positive this time next year, meaning if the non-tradables side of the basket, if that's not running closer to that Goldilocks 3% zone by then it could look like the Reserve Bank is at risk of inflation stabilising above that 2% target. Indicators of economic slack and current economic momentum certainly suggest that non-tradables inflation is going to continue to slow, meaning that while there are some upside risks to the CPI outlook from either the tradable side of the basket or some of these potentially structural high inflation issues, that's things like council rates, that's things like insurance, where we've got an infrastructure deficit, we've got weather-related risk that's coming through the insurance. There are parts of the CPI basket that look like they could run hotter going forward than they have historically because of some of these issues, but that's a down-the-track story. That's a structural story. The cyclical story right now does look to be one where the economy is running cold and inflation is coming down, which means it's entirely appropriate for the RBNZ to be getting that OCR back to a more neutral setting relatively quickly.
Miles Workman there. I'm Alex Tarrant, standing in for Bernard Hickey, who is away this week on family leave. That was 5 and 5 with ANZ for Thursday, October the 17th. Catch you tomorrow with what those Australian jobs figures might mean for the RBA.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.